The Dollar War. Podcast Script, Episode 4 of 4. Part 5. The risks that could change this analysis. The assumptions this advice depends on, and what could invalidate them. What would change the picture? No investment thesis is infinitely robust. The framework above rests on specific assumptions, and intellectual honesty requires stating them clearly. Assumption 1: Inflation remains elevated. If the Fed successfully brings inflation back to 2% and keeps it there on a sustained basis, tips and gold become less compelling. The evidence that this is happening is currently mixed. Core PCE remains above target, and housing costs continue to exert upward pressure on measured inflation. Assumption 2: De-dollarization continues. If BRICS pay fails to achieve operational scale, if the yuan remains inconvertible, if India and China's internal tensions prevent effective coalition building, the structural gold demand from central banks may moderate. The current trajectory suggests this is unlikely to reverse quickly, but it is not guaranteed. Assumption 3: Geopolitical tension persists. Energy and defense sector outperformance depends partly on continued global instability. A genuine and durable de-escalation in the Middle East, a diplomatic resolution to Taiwan tensions, or a comprehensive U.S.-China trade framework could reduce the geopolitical risk premium across multiple asset classes. Assumption 4: Your employment income is stable. This entire framework assumes a stable monthly investment contribution. If your income is variable, freelance, commission-based, or industry cyclical, the allocation percentages need adjustment, and the emergency fund tier should be larger. The tax considerations you cannot ignore. Investment advice that ignores tax efficiency is incomplete advice. Key points for each market. U.S. investors. Maximize your 401k contribution, $23,000 limit in 2026 if under 50, $30,500 if over 50, before any taxable investing. If you have access to an HSA, maximize that to $4,300 individual/$8,550 family in 2026. It is the only triple tax advantaged account available. Gold ETFs held for more than 1 year in a taxable account are taxed as collectibles at 28%, higher than the standard long-term capital gains rate. Consider holding gold ETFs in an IRA where possible. Bitcoin gains are taxed as property, short-term gains, under 1 year, at ordinary income rates. Canadian investors. Maximize TFSA contributions, $7,000 limit in 2026, before taxable accounts. TFSA growth and withdrawals are completely tax-free, ideal for ETF compounding. RSP contributions reduce taxable income and grow tax-deferred, prioritize for higher income earners. Gold ETFs held in a registered account, TFSA/RRSP, avoid the capital gains tax on appreciation. Australian investors. Super contributions, concessional cap of $30,000 in 2026, benefit from 15% tax rate inside super versus your marginal rate, significant benefit for middle-income earners at the 32.5% bracket. Assets held more than 12 months qualify for the 50% CGT discount, strongly favors DCA buy-and-hold strategies. Franking credits from Australian equity dividends effectively reduce tax paid on domestic equity income. Conclusion: the 5 things the Mitchells need to do this month. This is not a 10-year plan to revisit in a decade. These are actions for now. 1. Open a high-yield savings account if you don't have one. Move your emergency fund from a bank account earning 0.5% to one earning 4.8%. This is free money you are currently leaving on the table. Do it this week. Marcus, Ally, EQ Bank, ING depending on your country. 2. Start a gold ETF DCA if you haven't. Set up a recurring monthly purchase of GLDM, gold, ASX, or PHYS, whatever is available in your brokerage. Even $100 per month compounds meaningfully over 5 years. The geopolitical case for gold ownership has not weakened since we discussed it in episode 1. 3. Review your equity sector exposure. If your retirement account is 100% in an S&P 500 index fund, you have significant concentration in technology sector valuations that are not cheap. Consider adding energy, XLE, and defense, ITA, allocation as sector diversifiers. 4. Check your TIPS/I bond allocation. If more than 15% of your bond exposure is in nominal, non-inflation adjusted, bonds in a world where inflation is running above target and the political pressure on the Fed is to remain accommodative, you are taking inflation risk you are not being compensated for. 5. Reframe the goal. The goal is not to beat the market. The goal is to ensure that the purchasing power of your household, its ability to buy housing, healthcare, education, and retirement security, is preserved and modestly grown over the next decade, regardless of what the Fed does, regardless of what happens to the dollar's international role, regardless of how the geopolitical order reorganizes itself. The Mitchells are not going to get rich from this framework. But they are going to be significantly better positioned than a middle-income household that does nothing differently, holds cash, and trusts that the system will take care of them. The system will not take care of them. It never has. That is not cynicism, it is history. But the people who understand the system's mechanisms, and position themselves accordingly, they tend to come through these transitions with their financial security intact. That is what this series has been about. Final summary: the dollar war in 4 sentences. China is buying gold to build financial immunity against dollar weaponization, and every ounce it buys is one more reason for you to consider holding some too. The Fed's policy cycle reliably extracts value from middle-income earners through inflation, and the only reliable defense is ownership of real assets that inflate alongside the currency rather than accounts denominated in it. The BRICS financial architecture is not going to replace the dollar next year, but it is eroding the structural demand for dollars at the margin, and that slow erosion has long-term implications for dollar purchasing power that compounds silently. The middle-class investor's response is not to predict which of these forces wins, it is to hold a diversified portfolio of real assets, inflation-protected income, and global equities that performs reasonably well across multiple scenarios, and to do so with the discipline and consistency that time in the market, rather than timing the market, always rewards. A note to our listeners. This podcast series has covered China's gold strategy, the Federal Reserve's policy cycles, Iran's nuclear threshold, the BRICS financial architecture, and what all of it means for you personally. If you've listened to all 4 episodes, you now have a framework for understanding the financial and geopolitical shifts of the 2020s that most news coverage does not provide. Share it with someone who needs it. The Mitchells are everywhere. Stay curious. Stay diversified. And keep listening. This content is for educational and informational purposes only. It does not constitute personalized financial advice. All investment decisions should be made in consultation with a qualified financial advisor who understands your individual circumstances, including your income, debts, tax situation, risk tolerance, and investment timeline. Past performance of any asset class does not guarantee future results. Data sources: Federal Reserve, IMF COFR Database, JP Morgan 2026 Gold Outlook, BIS Quarterly Review Q1 2026, Bloomberg Consensus Forecasts, TreasuryDirect.gov, Australian Office of Financial Management.